Higher Exchanges, the #1 independent cannabis investing show, where we break down complex cannabis markets into clear insights you can actually use. Here are your hosts, Jerry Redmond and Morgan Paxhia.
Welcome back indeed. I'm Jerry Redmond, Chief Strategy and Investor Relations Officer at Leaf Brands, and I'm back again with one of, Morgan. I'm saying one of because Jerry is here, the smartest cannabis investors I know. Morgan, what's up, man?
Doing our thing, doing the cannabis world that we live in, whatever that is these days, but we're doing well. How are you doing? I saw you were just up at the farm. Love the footage you put out there.
So thanks, man.
Like
yeah.
Getting out there and doing cool stuff.
Yeah, I love it. I mean, I love a lot of things about Leaf, but one of the best things is that I'm just about 90 minutes away from our farm, so I can go out there and meet up with Micah and folks for some meetings. So yeah, we had meetings on Monday and Tuesday, shot a little bit of content, and then on Wednesday, the plants arrived. So I missed the plant arrival, but it's good times out there. We're just getting ready to put stuff in the ground.
Do you ever wish you could bottle the smell, and just bring it to people and let them smell what it smells like when a great weed is like growing kind of outside?
Yeah, it smells so good out there. When it's at full throttle, we've got about 1 million plants in the ground. And the last couple of weeks before harvest, it just smells amazing. Kind of reminds me. Let's just welcome you to the show since you jumped right in. Let's welcome Jerry Derevyanny, partner at Bengal Capital, back to the show. Jerry, formally welcome.
Thank you very much for having me.
You're welcome. Going back to what we were talking about, it reminds me of speaking of other Jerrys out there with the J. Seinfeld, when Kramer brought the beach smell back with him. Do you remember that?
I don't actually remember that. I should.
And he sold it to Calvin Klein when Calvin Klein had that like CK1 bottle.
The beach. Yes,
yeah,
of course.
Yeah.
How could I forget? Oh my God, how could I forget that episode? Yes.
Yeah, you strike me like you'd be a Seinfeld guy.
Yeah.
Morgan, you a
culture.
You a Seinfeld guy, Morgan?
I need to start watching more of it because it's available to watch. I watched the whole thing when we were young lads, but I haven't binge watched or gotten back into it. Like I've watched The Office, 15 times over.
Yeah, I was watching The Office with my girlfriend who watched Seinfeld beginning to end, and then we started The Office, and we had to tap out in the last season, man. Like once Michael leaves, it was okay when Will Ferrell came in, but then when Andy is running The Office, I think we tapped out like 7 episodes early just because we couldn't take it anymore.
Wow.
Did you have?
I remember. Yeah, I was gonna say. I remember there was this really bad episode of The Office called Prince Family Paper Company, where like they go and try to ruin like this family paper shop. I couldn't even get through that episode. Yeah, it was like kind of mean spirited, and maybe they have like a turn at the end. But I was like, oh, man, I don't want to watch this anymore. Like maybe I should go back and give it another shot.
It had a sweet spot in the middle. It was really great, but it's a bummer when you get to the end. You just can't take it anymore. We got through Sopranos. We're going to talk about stock soon here, guys, in a second. But Sopranos was a little bit that way too, where the last season was a bit weak, but still enjoyed watching that one from start to finish as well. I don't know. We're all kind of the same age, and I obviously have nostalgia about TV shows from a certain time.
Yeah. We're loving Landman right now.
Oh, that was so good, man. Yeah, I loved it. Yeah. 60
Ivan's watched Landman. It's so good. Billy Bob Thornton, Allie Later, and Sam Elliott, and I mean, it's just killing.
Anyone under 60 in the show?
Well, Allie's 50.
Okay, a fair point.
And then the daughter, I don't know her name as an actress.
Yeah,
but.
It's topical. It's topical now too. Remember, $60 to $90 a barrel. That's the sweet spot, and we definitely are no longer in the sweet spot.
It's real good. It's real good. Definitely recommend it.
All right, boys. Let's quit the bullshitting. People get pissed, man. Like when Boris was on, somebody threw up a comment saying, "Guys, we're 9 minutes into the show. You haven't asked Boris a question." It's like, guys, calm down. Like, I enjoy the banter, and B, we got to warm up a little bit. So we're 7 minutes in. People are going to be angry. So let's get officially into the cannabis conversation. Jerry, I want to start out with like what I think, like if you and I, we kind of treat this show, especially with guys like you that are just kind of industry friends, just like a conversation over a beer, or I haven't drank in 5 months. So let's make it over a joint for my sake, and just what we'd want to talk about. And if I were to like sit down with you, we were to, just talk about what's going on in cannabis. The thing I'm most curious about, starting big picture, just where do people find value today? Like if you're going to, let's assume, Jerry, you're going to be in the sector, which is obviously in terms of the hierarchy of decisions, like, are you going to be in the sector or not, is going to be the first choice you make. But let's say somebody wants to commit a portion of their portfolio to cannabis. Over the last couple of years, we've talked about so many different ways of doing it. There's the MSOS route. There's the focus on tier ones route, which is similar to MSOS, given the cap weightedness ish of MSOS. So those two are kind of similar. For a while, we talked about words like torque and reform independent versus reform dependent. Obviously, we've seen how that's played out, right? A third of the reform dependent basket is now gone, but I guess you could double down over there if you wanted to. And then there's other approaches too, Jerry, like if you want to focus on certain states or certain cost structures, premium versus efficient and lower cost. So with that as a bit of context, if you're just looking overall at the cannabis landscape, what is exciting to you? Where are you finding value?
So we historically focus on kind of the smaller names of an already small sector. And I think there is still value there. And there definitely are some smaller companies that punch above their weight. I don't want to, jump right into talking our book. I'm sure we'll talk about Grown Rogue later. I think out of the bigger names, I think if you're, it's funny to me. It's a question of like, how much money do you want to devote in the sector as part of your portfolio? The bigger question almost to me is like, well, how much time do you want to devote to it? Do you want to make it an easy call? Like the easy call is just kind of buy GTI and go away. Maybe if you want to be a little bit more creative, okay, buy some GTI, buy some MSO leaps, right? If you want to have kind of this torque from reform, right? Because that's probably going to be your max torque, I'm guessing. And then, but then if you really wanted to go dive deep and find real value, then it gets very interesting, I think, of what you can do. I think offhand, what we're starting to see now, I think something that's a little bit underappreciated actually in a lot of MSOs, larger MSOs, is their retail portfolios. Those are going to be some of those retail portfolios are going to be potentially much better than their back of the house portfolios, where the retail is going to be supporting the grow, and there's still some value there. Some of the people I think are showing accelerating retail prowess. You can kind of start to piece it together, and it's going to be interesting to see if that kind of holds up. I'd put Ascend on that list, which is, I think is, from what we've seen of their stores, like they do pretty well. Like they kind of know retailing pretty well. Not to speak ill of their back of the house, just don't have an opinion on it. But so you're going to start to see some of that. It's interesting because, definitely a mix of large and small. Just in terms of numbers, I think you're going to see more small become medium, medium become large, than large stay large, if that makes sense. I think some of the larger companies will probably shrink or stay in stasis as some of the medium-sized companies start to come up. I think that's broadly a fair thing. I actually don't. I know there's a lot of hate on MSOS out there for a number of reasons. As a basket bet, it is not for kind of low effort basket bet of like, hey, I want exposure to the sector. Here's what I'm going to do. I don't think it's the worst thing in the world, especially because a lot of this, I think that people miss is if people could go in and buy the underlyings, they probably would. Like there's a reason you do the ETF. And a lot of that is because maybe your brokerage just doesn't let you buy GTI, right? And it's hard to tell people just open up a brokerage account to buy GTI stock, right? So.
And you're a partner at Bengal Capital, Jerry. Just for a bit of context, will you explain to folks what you guys do there? And do you think that portfolio is reflective of personally where you think the most value lies?
Yeah, actually, with some, not exceptions, but so Bengal Capital, we run we're a fund manager that focuses on cannabis. We have a kind of a couple different funds, some SPVs, but one main fund that focuses on cannabis. We're different from everyone else. I don't want to say everyone else, but a lot of other people, in that we have a really broad mandate. Like, our investors allow us to do a lot of things that, we're not limited in concentration. We're not, like, we can really is like a blank canvas. So the things we own in the fund, like when we put in the investor letter, and we always put the proviso in there, but it's easiest to compare us to MSOS, but they're very, very different. Like what our fund is very different underlying. And we have debt in the fund. We have, common equity in the fund. We have preferred equity of private non-traded companies in the fund. We have convertible debt in the fund. We can have basically whatever we want in the fund. We wanted options in the fund, warrants. So that's what we do. And we historically have focused on, not even the top tier of companies, that a couple tiers below, because part of that is Josh, my partner, Josh Rosen, who used to be the CEO of Forefront, been in the industry for a long time. He's really understands the industry well. I think is able to add some strategic guidance, like some really valuable strategic guidance to companies. And so we kind of looked for situations where we could add capital and maybe some know-how, and to improve outcomes for everybody. And so that's one of the things that we focus on.
And I believe your largest holding in there, Jerry, is Grown Rogue. Is that right? Yeah,
Grown Rogue is the largest holding in the fund, mainly because it's grown to be the largest holding. The price has appreciated quite a bit from where we initially bought it. It is the largest holding. It is not a one stock fund as some people seem to think. It still is the biggest holding, but it's not the only holding that we have in there for sure. Grown Rogue, is kind of, for a long time, it's kind of exemplified the kind of company that we've tried to find, which is, we called it scrappy operators, where our basic theory approaching cannabis, and having worked in cannabis, is the ability to grow a good pound of cannabis. Like, how much does that ability get you if you're in the legal market in Oregon? Well, you make, a couple $100 per pound, if that, maybe $100 per pound. Like, I can grow a really good pound of weed in the legal market for $400. Okay, well, you're going to sell it for $550 or $600. Okay, well, that's a good business. Well, in Illinois, you can grow it for $400 or $500, and you can sell it for $2,000. So that's like we thought that there was like a huge chance to be portable with these skills, and that there was going to be a lot of torque from taking this skill set and applying it in other states. And I think Grown Rogue has kind of been an example, kind of the paradigm example of that.
And if I look at the stock price, which again is not always indicative of what's going on at the operator level, and I don't want to turn this into a full analysis of Grown Rogue show, but I think it helps get into your mindset to talk about it a little bit. Core operations in two super hard markets, Oregon and Michigan, and high level, Jerry, I haven't gone deep on Grown Rogue in a while, but it seems like those markets just continue to get harder and harder, and are presenting some challenges as prices just drop more and more. But then on the flip side, they're turning on assets in some higher margin states, New Jersey, moving into Minnesota, I think Illinois, if I recall correctly. So could you just talk, without like doing a full deep dive on the company, but more just kind of strategically how you think about that, where it's like the ice cube is melting over here in their core business, and then over here they're supplementing that with higher margins in some of the new states. Do you think the same things happen in those new states, and how do you see that continuing to scale?
Yeah, 100%. So here's one thing that I want to be very clear, that we try to be very clear on, and I think Grown Rogue does a good job in trying to be clear on, is that, and Josh was big on this from the very beginning, and I think it'll segue into another discussion we'll maybe have about like what it means to be institutional class, which I know for a lot of people is going to be silly to talk about for an $80 million market cap company, but it's important to lay the groundwork for this of okay, let's all admit that for a certain period of time, you'll be over earning in a certain market, because weed prices don't stay at 2,000 forever. Even though pro formas in this industry, if you've been around as long as we have, we've seen spreadsheets that years ago that never forecast prices to go below $2,000 a pound at wholesale. Well, they do. Like, we know it now, right? And so we have to admit that, the pattern with Grown Rogue is, to some extent, always going to be in that initial market. Yeah, we're going in there because the pricing is high, and we're going to give a good product at that price or below that price, that's going to give us some market share. And we're craft, and we don't have, there's not a lot of product to move. But the biggest thing is that, yeah, of course, they're going to be earning more in year 1, year 2, year 3 than they are going to be in year 4 and year 5. The biggest concern, so Oregon, I think Oregon is, listen, very, very tough market. Michigan, I think, saw some improvement towards the end of Q4, but we're in that time now in those mature markets that they kind of bounce in this range of, sometimes pricing will get really bad, sometimes it kind of returns to medium. Maybe you'll get a couple months of, hey, outdoor harvest has kind of cleared this year, so pricing on indoor kind of jumps a little bit. But these are mature businesses. And the biggest thing for me as looking at those is, do they still make money in those markets, even when it's mature?
Mm-hmm.
Because I think the thing people miss is that MSOs, like some of the larger companies, you don't see this as clear. Like Grown Rogue allows you to see this reality of the melting ice cube. It's happening to everyone. It's just more difficult to see with some of the other companies. And the biggest question for some companies is, okay, well, wait, are you going to make money when it's actually a mature market, when there's actually some decent pricing competition and, it kind of goes towards the median? And if you're not, like, that's a significant issue, right? Your terminal value there is 0 or less. And versus Grown Rogue, where it's like, okay, you still have some, a decent little business there. And the biggest question then from there goes, okay, well, how much was your facility in Oregon $100 million facility? No. How much money did you put into Oregon to make? Yeah, you're not making much, but how much did you put in to make what you're making? Well, a couple $1 million. Oh, okay. So return on capital is not bad.
Mm-hmm.
Yeah. Anyway, yeah, I don't want to sidetrack you too much. Sorry.
No, I think that's a good conversation. And I think we can complement what we've covered so far by getting into different ways, even with a company like Grown Rogue. Like, there's been different rounds. You could be in common. They've done a couple of different debt rounds. So why don't I pass it over to you, Morgan? Because I think you're the perfect person to lead the conversation in terms of types of instruments, different ways you can play stuff. Because normally, especially on social media, we're talking about investing in the common of these companies, but I think we've seen that risk come up. I mean, Forefront's gone under, Gold Flora's gone under, Air's gone under, Cannabis has gone under, and in some of those cases, having the debt wouldn't have helped you out. We wouldn't have sheltered you completely, but it certainly would be safer than having the equity. So why don't you dig in more and talk a little bit about that?
Yeah. Well, real quick, I just want to give a shout out to FlowHub. Get that because we haven't covered that yet. So all good. Yeah. So FlowHub. Bad host.
Sorry, FlowHub.
Yeah. So here we go. So, for folks that don't know yet, FlowHub is an all-in-one platform built for cannabis dispensaries, point of sale, inventory, compliance, e-com. They do it all. And they just dropped a fresh new brand, same mission, sharper image. The new logo is inspired by water and the idea of flow. Fluid, adaptable, and powerful enough to navigate any obstacle. Check them out at flowhub.com. I personally like the new brand, the idea of water. I'm
it looks great.
Sailor, Poseidon. So I was like, we didn't have any input on it, but I'm happy to see that. So, So Jerry, I know, we were talking about MSOS and you were mentioning leaps and, there's a lot of different ways to play investing in cannabis. Obviously, if you're retail, you're more constrained to what kind of instruments are out there. But, with private capital, working in pref structures, especially pref in private companies, converts, I guess as you're looking at it today with Bengal and, the various instruments you have been deploying, are there certain ones that you are favoring more so than at other times? Like, is there cyclicality in how you're thinking about deploying capital, or is it really just situation by situation? Kind of give us an idea of when you're assessing a debt instrument, a preferred, or just going straight into common, or maybe even, I don't know if you guys have done any real estate, just trying to think about these different kind of levers.
Yeah, so we're kind of at heart equity investors. We want that equity, like building that equity kind of upside. The reason why I think a lot of things happen in this industry is because as capital gets more constrained, you get to call your shot. Like, whereas you normally, if there's high demand for something, it'd be like, okay, let's buy common stock. Well, no one else wants to give the company money. Okay, well, now I can get convertible debt. So now I'm a little more protected on the downside, but I still get the equity upside. For us, I think we really do try to go, listen, for our investors' sake, we can't just give away the farm. Like we have an obligation to get, there's more risk. We should get a little bit more return and a little bit more protection. But also, we're not looking to really turn the screws, because we're trying, like the purpose of the capital that we give the company has generally been to grow and to make things happen, and that eventually is going to get to equity, right? That is going to get to equity value. The way so that's a lot of the way that we look at it is like, okay, the convertible debt, we call it, downside protected equity instrument. That's kind of a lame thing to say between each other as partners, but we don't actually say it all that much, but that's kind of how we think about it. And so a lot of it is in like what structure we pick is in that context. Now, we've done preferred equity in a private reinsurance company, and that was a very friendly deal, and that was the general deal that was going around. We thought it was going to be great, and it made a lot of sense. And so that was again one of those meetings of like, okay, they had X capital needs, and kind of there was a decent amount of demand, so they had kind of lighter terms than they would normally get. With retail, right, investors, listen, if you're an accredited investor or qualified investor, like you have $1 million to deploy in the sector, you have a lot of flexibility. I mean, number one, you can go, if you like what Poseidon's doing, you can call up Poseidon and invest in the fund. Like that's an option for you, right? For retail people, you're more constrained, but actually not as constrained as people might think, right? It's really interesting. I think MSOS doesn't get the credit that it deserves for, these are tools. You use the tool how if a hammer is useful to you, use it. If it's not, don't. So you have options coverage. Okay, if you want to make a bet on reform coming within the next 2 years or so, I just don't know of a better kind of like, if that's the specific bet you want to make, buy some leaps if they're reasonably priced. Also, I think that some of the debt providers in the space, there was a run on them, and then a lot of people have forgotten about them. I think there's an argument that there's some decent value for investors in looking at, okay, there are publicly traded companies whose sole purpose is to provide relatively expensive debt to cannabis operators, and cannabis operators definitely need this money. Maybe it makes sense to invest in those companies. And now effectively you're kind of like, you are a debt provider now, to an MSO, and you didn't have to buy a True Leaf bond to do it.
Yeah. So, there, to your point with retail access, there are like Chicago Atlantic has a publicly traded vehicle. You have IIPRs publicly traded. You have Chicago. Yeah, Chicago too. Right. They've got their BDC and their, is that a REIT?
It's a mortgage REIT.
Mortgage REIT.
MREIT. Yeah.
Yeah. And then you have like New Lake, and then, am I missing anyone?
IIPR?
Yeah, IIPR. Yeah, AFC. Well, AFC is kind of
AFC.
Yeah, but yeah. So to your point, there's other ways to access that. I think it'd be really interesting if there was a publicly traded vehicle for preferreds. If if preferreds become more and more common as a tool for these companies, because most of them cannot really take more debt, and if there's really not much demand for common, preferreds could be an interesting way, because I know it sits in a weird spot, but there's a little bit of cash, maybe a little bit of upside depending on how they're structured. So
yeah, let's pause there for a second, guys, on the preferred thing, because I think that's an interesting nuance. We recently did a raise where we did some in common and some in the preferred, and with the common, with ours, it came with a warrant as well. And so I think if it's a home run, you probably do better on the common, because you would get your share that you purchased. Plus, in our case, the warrant was 5 cents higher. So you would buy it at 25 cents for the common share on the Canadian side, warrant at 30 cents. And if you think Leaf is going to $1, you would really like that, because you pick up the warrant and you pick up some additional return there. However, going back to this preferred concept, we did a preferred as well that converts at 38 cents and was 15% interest rate on it, 10% cash, 5% PIK. And so in that case, an investor is going to get paid while they wait, which has been a great strategy so far. One day that changes, right? But going back to what you're saying, Morgan, yeah, the idea with the preferred where I can collect a dividend, quarterly in the meantime, but still get that equity exposure down the road if it's a home run. I think is a cool structure, because if you're just on the debt side, that's not a convert. The thing I don't like about that, I'd love to get both of your feedback on it, is if you think there's going to be a point in the future where this thing does turn around, and if you think there's a 50 or 100% year this year, next year, down the road, on the debt side, if you're correct about that, you don't have that kind of opportunity for return unless has a conversion feature or you went the pref route. So it seems like, to me, my pushback on the debt, probably because I'm just too much of an optimist in general, would be that I don't like having my upside capped.
Jerry?
Yeah, I listen, I agree. To me, what's fascinating though is like, I completely agree with you. But if you're building a portfolio and you go, okay, I don't want to have my upside capped either. So let's say I do 70% of the portfolio in, some of my favorite equities, and then get 20% or 30% of the portfolio in some of this. Yeah, it's upside capped debt. I think it could be interesting, but I generally agree with you. Pref is such a weird thing. Like, it's just not common, just generally in finance as much as it used to be. I think like preferred shares used to be much more of a thing back like 50 years ago, like widows and orphans, you kind of put it away, and it's not really a bond, but it's kind of consistent money for a while. Banks still issue a ton of them. I don't really know who invests in pref. Like, I don't know. I think a lot of times you're dealing with a very different investor base than would normally look at like a convertible debt or debt issued by an MSO. I still think, by the way, that for banks, for like a tier one bank. So I didn't know about this. So a bank that gives a loan, like generally they're giving deposits, like depending on how risky the loan is, they're giving your money to, and a portion of it is the bank's equity. For the riskiest loans, bank regulators come in and say, no, this has to be 100% backed by your equity. It's too risky. And so the cutoff for that is LIBOR plus 5. So this is the reason why you see all these cannabis loans are like LIBOR plus 4.99 or 5 and nothing above, because they'd be automatically in the risk rating category that's the highest, which would like destroy the profit for the bank. The banks that are writing this paper, I think for like GTI to write like LIBOR plus 5, I think GTI is like LIBOR plus 5 or whatever it is, like that's an incredible value for the bank in my mind. You're getting something that would be rated, maybe not A, but would probably be investment grade rated, almost certainly. And you're getting it at a yield that's like probably double investment grade. Anyway, I think it's a steal for the banks. But the question was about prefs.
Yeah, I was just kind of digging in a little bit about how you can get the yield there, but also you have some upside. If things go really well, you can do the conversion, end up with stock exposure long term.
Morgan, I don't know how you feel about this, but like one of the things that I don't love in prefs is as they have been used in cannabis is cash pay. Like where the interest where the preferred return is paid in cash every quarter or month or whatever. Because to me, it's like, wait a second, okay, this is growth capital, kind of supposed to be. This is a growing business. You're supposed to have good returns on that. Like, this cash is supposed to be generating even better returns in the future if you continue to put it in the business. But instead, you want to pull it out. Like, why would I want to pull 15% out of the business if I'm making more money keeping it in the business, and eventually I'll have earned 25% a year on that cash, if that makes sense. Like, that's why cash pay keeps you honest, but it's not one of my. I don't love it sometimes for pref stuff. Like we generally, for a lot of our stuff, have preferred to keep it PIK, like just accrued interest.
So over a dividend, like an accrued preference, or just a traditional like PIK?
Depending on the instrument, but not accruing a preference, like a liquidation preference, but accruing just, hey, it's 10%, but you don't have to pay me in cash. Just keep accruing it, and it's in the business. But I would rather the cash stay in the business than take out 10%, and then what am I going to find some other use for that cash?
Yeah. there's definitely pros and cons, because that preference can compound, right? 15% if it's PIK, and then you can start to lose management incentive, because you start diluting down the common value, right? So it cuts both ways. I mean, for starters, to your point about 50, 60 years ago, I mean, we used to be much more cyclical and capital intensive kind of companies that were doing that. Versus a lot of the mainstream companies today are much more asset light, or they were before this whole AI thing.
Yeah.
So they didn't need to do that as a means to attract capital to invest. But as venture, I mean, we basically, if we're doing private companies, it's all preferred equity. If we're doing equity, it has a conversion, but it has that liquidation protection. But we're balance sheet people. We try to be pretty diligent about that. And so the tricky thing with pref is it's junior to UTP, senior secured pref. And so like if they can't service their own debt, you're not going to get your pref anyway.
Mm-hmm.
So you're and you have no real protection because of the debt consumes the company's value. So it's just we think about it on case by case basis, but certainly with growth capital in these private companies, we certainly do the pref, because there's other protective provisions that looking at, but again, for these more mainstream access points, there's really not availability to that to get access to that kind of capital or participation rather. But I think for these larger companies, that the few that don't have leverage balance sheets, I think Leaf is one of them. Jesse, I think it was a smart approach to doing it, and how you kind of did the hybrid of what Jerry was just saying, where some of it's cash, but some of it's PIK.
Mm-hmm.
So you're not taking all the cash out, and as long as your ROI is sufficient, then that cost of capital is worthwhile.
Yeah, one of the nice things about paying some cash interest is that it keeps you honest. Like
Yeah.
if it's all fugazi, if it's all like, it's just accounting numbers, it's just going up on a spreadsheet. Like there is something very real about, okay, I gotta make a payment this month, this quarter, whatever, which does kind of hone the mind a little bit sometimes for operators. So I think there are definitely plus and minuses.
Drives that cash, or drives the diligence, or keeps them, to your point, keeps them honest on managing the cost side of their business to make sure they can service that. The other aspect is a little nuanced, but even a PIK is you still have a phantom income tax on that. So at least if you're getting the cash, you're getting something to pay for those taxes.
Morgan, this is something I had to learn about just a couple of years ago, interestingly enough. So yeah, it's education of a fund manager. But I didn't actually get the money. It's just sitting in a spreadsheet. But the IRS thinks you got the money.
Yeah.
How do you guys on the allocating side, where you sit, think about a convert versus a pref?
For me, it's they're obviously they're really similar. They're kind of like right, very close to it. You're either the the bottom of the top or the top of the bottom. I think that it just kind of depends on. I actually think, in my limited experience, that converts are easier because they're prefs. Oftentimes, companies don't provide for them, and they have to do a prospectus or whatever, where they have to create a pref class and do if for public company, we've talked about it with some of our former investors, oh, let's do a pref here, let's do that, and it's well, we'd have to have an annual meeting, and they'd have to approve a pref. It's okay, well, let's just do a convert. We're just looking for that equity exposure, but with a somewhat of a protection, and let's do that.
Yeah, I'd agree. It certainly is way less of a lift. And, it's when you're talking about growth capital, it's tricky that you don't want to sink a ton of cash into legal fees. You want as much of that cash going into actually generating value than, having to get paid back out in just, one-time expenses. So, converts are a very low-cost way of being able to deploy capital and still kind of get some of those functions that you want, and especially warrant kicker, and you can really still generate that upside you want. Tricky thing with a convert, though, again, is if the balance sheet's already over levered, there's a ton of senior secured, then taking on a convert is, or the proposition to an investor is a little tricky because they're like, how, you're not getting as much of that downside protection because most of it could end up just going to the senior secured.
Which goes back to our previous discussion of you can invest in some of the quasi senior secured, to hedge out, to invest in refi, Chicago, Atlantic. I hold it in my PA, by the way, like that's why it's kind of top of mind. And go, man, like 16, I think it's like a 16% dividend yield right now, annualized. Like, well, okay, that's not terrible.
Yeah. And but I think it's a good idea of like, because no one knows when things will change. We don't know. So at least, if you're getting some cash, and, they seem like a good team that's executing, because there's been other debt providers that have gone under. They've written bad loans and didn't get paid back, and that was the end of that. So just because it's debt doesn't mean it's safe. I know there's just this common thought that, debt is a safe investment, but it's not. Doesn't mean.
I mean, listen, I think one of the mistakes we made was, in some of our investments, how we underwrote, like, okay, some of the parts, like, okay, we could take this, like, our downside is protected by if you took this license and sold it, and you took this license and okay, let's give it a little bit of a discount or whatever. You don't realize how much the tide has kind of drifted up your valuation expectations until that tide completely disappears. And suddenly you go, wow, okay, I thought this license over here was worth $8 million, and now it's worth $2 million, maybe, and there's no active market for it. So yeah, no, it's
2, and it's going to cost you $500,000 to go through a process of getting control of it. And
yeah.
So I guess just to kind of wrap up the segment, so the way you would maybe categorize is like, it's kind of part of the overall strategy is it's good to have some of these cash flowing kind of things, and then, still keeping an upside participation. Is that a fair summation for?
Yeah. I think one of the most interesting strategies somebody could use is have a portion of their portfolio that, like, okay, I'm getting 16% dividend yield on, like, getting a little bit of money and using that money to dollar cost average down or up or whatever on the equity side, basically having it feed like that. I don't do that, but to me, it's always been kind of fascinating thinking about it.
Yeah, I think that's an interesting approach and a smart way to keep investing. There's a lot of chatter about, whether DCA works long term in cannabis. I think investing in general long term, it can be a good way to go. Cannabis is so tricky because when something goes one way down for 5 years, like no matter what your investment technique you were using, unless it was short selling, it probably worked out terrible for you. But one of the things I've been thinking about a lot over the past few months, guys, are brands. And I think about them because at Leaf, we're in the bulk wholesale business. We've been in the brand business in California before. We pulled out of it a few years ago. Now that we have the farm fired up, we've been, having more M&A conversations about whether brands make sense again to put some of our low-cost inputs and capture some additional margin at the retail level. So that's got me thinking about it. I've been reading some books. I read a good book by Seth Godin. I can't remember the name of. Read a good one called Building a Story Brand 2.0, where if you're in the marketing space, is really good about building a brand. And then a book I absolutely can't recommend is Berner's latest book, Hoofda. I thought I might read it and learn a few things not to do, but it's just turned out to be a complete waste of time. But in the book, he's talking a lot about building the cookies brand, and I thought there might be something to be learned there. But it's mainly an ego-driven story about how awesome the guy.
For lawyers, there's something to be learned for lawyers.
Yeah, I'd say that's probably true.
Who's the worst? Adam Bierman's book or Berner's
I didn't.
book? So
I
not
didn't
to
pick
name
up,
names, but
yeah.
just
Yeah, I didn't. I miss Bierman's.
Sorry, I can't resist saying something. His whole tour to promote that book of the whole well, what did you do wrong? Well, it really everything rolled up to me. This grand pronouncement of I take full responsibility, but I'm not going to say anything specifically bad that I did, so that it's kind of launderable. So I'm going to launder my reputation without actually taking blame for any specific thing that I can still deny. It was pretty amazing to watch. It was very well delivered. You have to admire people that can go on a podcast or an interview and deliver a line of just total bullshit with conviction.
Yeah. Everyone is a bad partner. Everyone stole from him. Everyone was a bad investor. He's just done the right thing, but just somehow he keeps getting around all these bad people.
Yeah, those bad Gotham Green guys who, didn't like the fact that I was, running a circus and just spending so much money. And then, who could have known? Like, get out of here.
Yeah. So I've been thinking about brands in a lot of different ways, but for this conversation, I'd like to talk about what is a brand in cannabis. So why don't I start with you there, Jerry, and then we can dig in from there. If I said, what is a brand in cannabis these days? How would you describe the high level traits of that?
So for me, just in basics, that like a brand means one of two things. It's either at the same price point, you're able to sell more, or you're able to sell at a slightly higher price than like general market because of that brand value. Those are like the two things that brand means to me, right? On the wholesale side. What's really interesting in cannabis is that the definition of brand has to expand now because there are retail brands. Like one of the really interesting things that we've seen just societally is that store brands used to be bottom of the shelf. No one touched them unless you were like working class, like really not doing very well. Like who's going to buy the store? Now store brands like, dude, if you're buying 365 organic, like that's pretty good. Like people respect you for having that in your pantry. I think it's really interesting that retail, I think we kind of undersell how much retail can have as a brand and as a source of trust and how much that will then flow back into product. But to your initial question, like what is a brand? A brand is being able to like if other people are selling 100 pounds at this price point, your brand allows you to sell 120, or you're able to get, instead of $1,000 a pound, you're able to get $1,100 a brand per pound. And there are totally logical reasons why customers would pay you for that, right? It's not just like fooling people into giving you money for the same thing, or something like that. There are, very tried and there are reasons why that happens, and it's very logical.
Do you feel like we've found actual brands in cannabis yet?
Very few, very, very few brands. And one of the things that fascinates me as an investor, and I loved your guys' input on this, is based on the data we have now, like we're looking out there, right? And looking at, okay, if you take a look at the sales stats, Headset or FlowHub or anything, and you look at it and go, okay, who's the top seller? Okay, that they have brand. Well, do they, or do they have just really good distribution, which is really important in of itself? Like, okay, these guys are the biggest retailer in Ohio. They have a lot of throughput, and like, you don't know that the consumer is buying them because sometimes that's the consumer's really only choice, or they're the best out of what they've been offered. And when they get offered more choices, maybe that brand weakens quite a bit, right? And some of the other brands that have been built in cannabis were absolutely built on unsustainable advertising and discounting. Like I think, frankly, Select was an example of this in hindsight. And I don't know that story. Maybe I'm totally wrong on that, but I think, frankly, MedMen as a retail brand was built a lot on this. And you're kind of seeing a flash in a pan, but it looks like a really powerful brand, but then it kind of goes away over time as that support gets pulled.
And so are you getting at there, Jerry, a bit, or am I on the wrong track here, that by having vertical channels, you can push products through them and give the illusion of being a strong brand when it's just really primarily a distribution advantage?
Yeah, well, it's hard. It's hard to for an investor. Frankly, the answer is I'm not sure. When I look at it, I go, it could be one, it could be both, it could be the other, right? Or it could be neither. It could be just, man, everybody else in that market is just even worse. And so as an investor, when you're trying to put this stuff together in a lot of other contexts, like in food or something like that, when you look at these stats, you know that the consumer is being offered a full choice of whatever kind of food they want, whatever kind of candy bars. And if this candy bar is coming up through the ranks, it's like, okay, that's probably based on the quality of the marketing, the candy bar and all this stuff. With cannabis, like, okay, with the verticality and all these other things that are throwing it off, it's harder to make that connection between brand power and sales, right? And I think it's a little bit more nuanced and challenging, honestly. Like, so do you guys think I'm wrong on that? Like, if fair, honest question, like, do you guys think about it differently?
Yeah, I think it's just really early still.
Yeah.
For brands, true, like brand affinity durable, because there are all of these nuances of actually scaling a brand if you're not vertical, and you're enter competing markets. It's very tough to get that shelf space because there's large agreements with, wholesale partners, and, there's horse trading or whatever you want to call it between large partners in markets. And so breaking in, like, without that really strong consumer demand pulling it in, it's hard to do that. And then you're also competing on, as you're mentioning about price of, if you don't truly have that scale, what price can you offer that's competitive that the consumer will demand? Because if they know they can sell, like in retail, if they know they can sell 30% of this company's products and they get this pricing, how are you going to break into that and, really get a reasonable amount of shelf without having to give a lot of concessions and stuff? So I just say it's tricky. I give brands that are breaking through, the few that really seem to be doing so and doing so in multiple markets, give them props for that, because it's tough. I mean, we like retail, like that's definitely been our bias for the last several years. But pairing it with a good back end is just makes it all that much sweeter for companies that can truly execute on that. But it still comes down to the point is, like, if you're going to build the back end, you got to do it right, because you got to do things that your customers want, and do it repeatedly. And we've seen fits and starts of MSOs, not the most interesting or appealing brands, just trying to plummet through because they have the retail, and about how much does it actually resonate with the consumer. And as they're learning, and some are learning, I think Ascend is a great example. Jerry mentioned is like, they put a lot of thought into their brand refresh that they just did, and sounds like it's going really well for them. And having that just dedicated focus on the consumer and bringing products that they want, is really important. But kind of long-winded answer. It's and I hate to just not be definitive, but it's it still is really hard the way the regulations are designed and the way these markets are evolving. You can't just enter Florida with a brand, right? You have to have some kind of partnership with a vertically integrated operator there, but that's the licensing scheme.
And if we get away from being super fancy and talking like about all the things a brand means, and I agree with the things that you said there, Jerry, but one of the underlying conditions has to be you're consistently making something great that somebody wants to buy over and over again. And I like the other pieces you put it about, the price or the premium or versus other alternatives. But I think that we sometimes get lost in the cannabis industry, and I feel bad saying this, but I feel like it was that way at Hall of Flowers, where I got a bunch of samples of flower from there. And a lot of it was very uninspiring and not awesome. It was okay, but it sure as heck wouldn't make me be like, let me look at this brand and try something else of theirs. Instead, I got literally, guys, I got like 8 bags of flour there. 6 of them were some kind of runts, and 2 other were some sort of purple candy thing. And all of them smoked fine, but none of them said, well, there's actually a really good jar from Maven, which I'll set aside over here as being a standout. But the rest, I just kind of put in a bucket and say that was okay. But without all the other fancy stuff and the packaging and the marketing and all that stuff, just what was in the bag didn't make me, I didn't hate it. It wasn't the point where I'm going to say this stuff was trash, but it was clearly the point where, like, okay, I got this pretty much given to me, grateful for it. But if I went into a dispensary, I sure as heck wouldn't ask for it again. And I think that problem starts in one state. Like, you talk about cookies. Like, for a while, cookies was freaking fire, man. Like 2014, 15, into 16, when they're doing most of their own growing, cookies in those original strains, Thin Mint, all of cherry pie back in the day, the real cherry pie, like all crazy fire stuff. Then they lost the genetics. Then they started doing contract grows, which means cookies isn't growing it. Instead, they're hiring different growers across California. I knew people, the friends of mine that grew for them to grow the strains. That's harder to control quality. So that's one challenge of scaling the brand in California. Now, let's keep going on cookies for a sec. You go to Maryland, you go to New Jersey. I don't know all the other states they're in, but how do you replicate that same success in, Florida, for example? Very different growing conditions in California. New Jersey, Maryland, also different, theoretically different genetics. And so how do you get that kind of consistency, especially in a flower brand? And I've had this theory, guys, which I don't think is super clever, and I'm just curious if you agree on it, but I think the opportunity in a brand is easier outside of flower So take like Wild and Groot and that sort of a partnership
Mhm.
where you're using oil for edibles and
Way
maybe
more
you could,
standardized. Yeah.
yeah, you can have the edible formulation, you can get similar distillate, live resin's a little bit different, rosin's a little bit different, but more similar-ish. You could get similar chocolate ingredients and all that sort of stuff. So a lot of talking there by me, but I think that the point that I'm trying to get across is like, I think a brand has to be something that people want, has to be something people are going to come back, like you said, Jerry, to over and over again, has to be a consistent across that state. You can't have bad batches. And then the challenge to me gets even bigger when you try to scale it to new states. And then I think the last point, which I'd like your feedback on, is that degree of difficulty, I think is probably hardest in the flower space.
I definitely agree in the flowers. I mean, listen, it's an organic. The more you process something, the more you can standardize it. Like flower as it's grown, it's a pure organic product. Take it as it comes. Like you can obviously control some of the growing, but a lot of the stuff is going to be chance and slight differences harvest to harvest. I completely agree with you. Although the one nuance that I would say is, well, few people are consuming cookies in California and then flying to Florida to try it. Most people are having it in their locality. So maybe it doesn't have to be the same California to Florida. Maybe it just has to be consistent within their markets, right? So like,
So
and I think
be in
that's
the
still a
top
problem.
10, be in the top 10%, 20% of quality within that market, is what you're saying, Jerry?
Yeah, or be in like the bottom 10%, but to be in the bottom 1% of price. You know, like
yeah.
there's, I think, you know, fundamentally, right? If we step back, it's like, okay, let's say let's say I can grow a gram of weed for $1. Like I can do it in my garage and it would cost me $1. Let's say I value my time and it'd be a total of $2 a gram. Why would I go out to a store and pay $5 a gram for a weed? Well, it's got to be probably a little bit better than what I do. It's going to be more consistent. And like it has to be something that most likely the value that I'm getting is like, man, for me to grow this weed, it would actually cost me like $7 a gram for me personally to grow this weed, because I'd have to take so much good care of it. I'd find the genetics. I'm willing to pay you $5 for it.
Mm-hmm.
Like, right? Because that value. And I think it's like In-N-Out doesn't do a ton of advertising. The advertising In-N-Out does is how good that burger is when it hits your mouth and how much you paid for it. Like, it's not really that much money and it's a really good burger. Like, that's the value that you get. And that, I think, accrues to brand. That's like some of the strongest brand building you can get. And that's, frankly, in cannabis, we haven't seen a ton of that because, you know, for totally understandable reasons, companies have been taking advantage of the high pricing while they can, you know, to some extent in a lot of these markets.
Mm-hmm. Yeah, and last topic, Morgan, then I'll pass it over to you to talk about being institutional quality. But Jerry, do you think the brand opportunity changes when we get to interstate commerce? Do you think then the value of that California brand actually goes up? Because right now, California brands in New York and other states are popular, but if they're playing by the rules, they're a California brand, you know, growing New York flower, making extracts out of New York flower, and they're really beholden theoretically, if they're playing by the rules, to doing the best you can in New York, but with California branding. Whereas what I see it long term, and again, I'm wearing my Leaf hat here, but you think about it with the Connecteds, with the Glass Houses, you know, with the big California players. Once the product is actually coming from California, do you think that's going to make it easier to scale those brands with real California products up there?
I think it's going to be, for some brands, it's definitely going to be a lot easier to scale when you can have all your production in one place. Cannabis, I think, is relatively easy to ship. You know, we've been doing it for decades while keeping quality relatively consistent. It's, you know, this is not like alcohol where it's really heavy. You know, price to weight is really kind of works against you. What I would say is my theory, or I could totally be wrong on this, is that because consumers reliably pay for kind of like indoor quality, which tends to be more expensive, and they reliably pay for, like, you know, a certain portion of the market is craft. I think you're going to have a much more fractured brand market than what we are used to seeing in beer. You know, people compare cannabis to kind of the beer market a lot. I think you're going to be way more fractured than that because, frankly, yes, Leaf, Glass House, like they're going to be able to outcompete a certain portion of kind of like mid to low level indoor facilities east of the Mississippi. But some decent facilities that have decent costs and a decent local following, like are you really that sensitive? For a lot of people, are you really that sensitive between like paying $2 a gram or $3 a gram when you come in for your eighth? Like, not really. So you'll buy from the local guy that you've known for a long time. And I think that lends itself to like a much more fractured environment. So like the equivalent of way more microbrews than we even have now. And that used to not even be the case in beer. But so I think we're just naturally going to have a much more fractured brand environment. But for sure, for some of these brands, especially for extracted brands, especially for edibles, listen, if I told you, the other thing is that as right now, a lot of the customers are, they're weed users. They're people that smoke. They're people that have smoked. They do some edible. It used to be kind of like clockwork that 15%, 10 to 15% of the market was edibles. 10 to 15% of that was liquid edibles. Hemp beverage, if you just looked at that data, you'd be like, nobody wants hemp beverage. Look, what are you talking about? Nobody wants low dose THC beverages. And then it explodes as a category because my theory is a bunch of the people that were buying it were substituting alcohol. They're not the people that go into a dispensary. The data did not show any of those people or their preferences, right? And I think for hemp beverage, interstate is a must. Like you need to have that centralized production. You can't be popping up this stuff all over the place. So the answer to you, I wholeheartedly agree. I just don't think that those big brands are going to control as much of the ecosystem as they do in other sectors.
Unless they own the retail too.
It's funny because that vertical integration can be one of the best things for a customer, because the customer comes in and every purchase, everything, every conversation with the budtender, they're telling you what they want. They're giving you very valuable information. And if that information gets transmitted back to the production, and production's like, oh, okay, like we know, like we know what's going on, and like that, and then they ramp, like they change production a little bit to give the customer more of what they want. Then it's this beautiful circle. The issue that you have, I think, naturally with verticality is that to the extent that the retail store becomes like an arm of the wholesale operation, that long term can be really bad, because eventually customers, where there's enough competition, and competition comes to these markets sooner rather than later, like customers go, wait a second, like why am I going back to this store? Like I go to this store and they got better stuff, cheaper, I don't have to, like, I'm not really happy with it. And over time you're like, well, wait a second, like what did I win? Okay, I moved a bunch of my product, but I lost a bunch of retail share. And over time, it's like you have to balance these things out, which is why I tend to get very skeptical of when companies tout a very high verticalization rate. And then my favorite is when people talk about, well, it's like Trader Joe's. No, it's actually nothing like Trader Joe's. Trader Joe's doesn't make any of their own stuff. They white label with very good manufacturers for their stuff. This is exactly the opposite of what vertical integration is. So yeah, I agree with you. It's definitely a risk.
Well, I know we're being mindful of time, so just wanted to get into this institutional quality discussion. And this first question I have couldn't be more topical, because I'm sure everybody saw yesterday Weedmaps actually filed to delist from the Nasdaq. And the stock has subsequently gone down something like 60%, trading below cash, yada, yada, yada. I know there's more to the story. But, a lot of the world's focus, the cannabis world that is, focus has been on the idea of rescheduling and a pathway to uplisting, and that being this great panacea without really any acknowledgement about the fundamentals. Which, some of us like to talk about fundamentals, balance sheets and profitability and brand and, all these things. But how should investors think about this, holy grail of when we do get access to the exchanges?
There is probably a class of people for which NASDAQ uplisting will solve all their problems. They're the people that have been trading the stuff that managed to get in very, very low, that are looking for the pop, that first day, first week, whatever pop. They're going to unload their positions. They're going to take their winnings and go home. And it's not about long-term value. It's not about any of that. It was about a trade. And that's it. NASDAQ is not a solve for this stuff long-term unless some of these other problems get addressed in the business, right? The stock is like supposed to reflect the business. And in some cases it does, in some cases it doesn't. But ultimately, the idea that Nasdaq is a fix for all these things versus does Nasdaq magically change your balance sheet? No. Does Nasdaq magically cause more people to come in and buy weed from you? Generally, no. That's all business fundamental stuff. And so I think, first of all, I think people are vastly overestimate how quickly uplisting happens, right? These are hidebound, kind of old school regulatory organizations that are going to cover their butts. They're going to talk to lawyers 18 times. They're going to kind of go slowly. They're going to, and frankly, I don't know, especially some of the kind of lower to mid tier MSOs that have real bad balance sheet problems. I don't know if they're going to even qualify based on Nasdaq minimum listing. I'm not even talking about the stock price being for initial listing, I think you need $3 bid, and a $1 continuing. Some of it's going to be wait, do you have enough shareholder equity? Negative shareholder equity. How do you do that? You're going to need to do a raise to do it. I don't know how much capacity there is to do that, right? If you look at, it was pretty impressive that Curaleaf and TerraSun were able to get some raises done when they went to the TSX, and obviously the Nasdaq's probably going to be more, but it wasn't like it completely flipped the balance sheet and changed it. Maybe with a little tailwind, it will. I think people generally are over-indexing on reform to solve business problems. And I think the best MSOs, it will become clear which of them are listen, reform is great. There's very little we can do to control Schedule 3. There's very little we can do to control what happens in DC, right? We can do our best. We can go. But ultimately, there's so much randomness, we can't do it. But what we can't control is what we grow in our grows, what we give our customers, how we serve them. We're just going to continue doing that and really focus on that. And that's going to pay dividends long term. And those are the companies, when they hit NASDAQ, that's probably going to be, it's going to be you're going to look back 6 months after they hit NASDAQ and the stock price is going to be probably meaningfully higher versus some of the companies that hit NASDAQ and it gets easier to short when they're on, you want to complain about short attacks or whatever, it gets easier to short on all these larger exchanges that 6 months later they will not be doing as well.
Right. So it's like a K-shaped effect, really. For those that are doing well, will do better, and those that are struggling will do probably worse. Because it's interesting is I think there's a lot of fragmentation, a lot of challenges in a highly illiquid public market that we have. But in aggregate, over time, it does kind of generally reflect the state of these companies overall. I know there's individual movements, and just to give you an example or some context around this, I don't know what MSOS did last year. I'm pretty sure it was down. I just don't know how much. The top 10 companies, public companies, revenues declined 7% last year. Operating cash flow declined 39%. Do you think if that was the reverse, if they were up high single digits or double digits and then kicking in that operating leverage that drove 40% operating cash flow improvement, would MSOS still be down last year?
Yeah, listen, I completely agree with you. And I think we are singing from each other's hymn books here because, when people talk to me about oh, what are the catalysts for, stock price improvement? I'm like, well, why doesn't somebody scratch a year of 1 billion in operating cash flow out of the same assets? You think you really think that nobody would notice the stock at that point? It's we've completely forgotten about basic business performance. And the idea that multiples would expand. And again, outside of this temporary pop, right? The idea that multiples would expand across the board for everyone, I think is just exactly why you point out. It's listen, higher than market multiples are for market growth. Higher than market multiples are generally for higher than market growth or higher than market stability. We don't have either of that. So generally you have a lower than market multiple, and based on kind of a normalized multiple, you're actually not too far off. So even if the market doesn't have accurate price discovery right now, I'm not seeing huge, strong arguments for why the price should be any different I guess broadly, for specific companies, I can definitely go back and forth, but broadly on a sector basis, I don't know. And then, at one point you could argue that 280E going away materially raised cash flows. You cannot do that anymore, right? Because for all the big companies now. So yeah, I agree with you. A lot of it is, and to go to like what is when you go to Nasdaq, it's not just going to Nasdaq. If you want institutional investors, if you want what people mean by wanting institutional investors is that when your stock price goes down, there is a mutual fund that has billions of dollars and many positions, and when they see that your price goes down to a certain level, they go, oh yeah, no, I'm very happy to own that stock at that level, and they come in and they do that. In order to do that, they have to do diligence, and they have to do institutional class diligence, which means not getting MNPI, like material non-public information. They need to be able to put the business together based on what your public stuff is, right? My example of this is always car dealers. If you open up AutoNation or Lithia's like disclosures, you have a very good idea of what a lot of the car dealerships are doing, what they like same store sales are, all this stuff. If you open up a lot of these financial disclosures for these companies, you don't know what the states are doing because they don't tell you. And a lot of things are intermixed into one. So they're going to have institutional quality disclosure to go with these things, right? And it's going to, right now they're putting in a lot of it is percentage. Like my favorite game is like, well, our gross margin stayed at 50%, it's a win, or our gross margin went up a little bit. Well, how much dollars is that? Oh, gross margin dollars are down. That's not a good, and in capital invested in the business is up. That's not usually, that doesn't get you high multiples in the market, right? Like as a general rule, that's not a recipe for high multiples.
Yeah. So the, just be mindful of time. The, another challenge, I think, and we've dealt with this and we see it pretty regularly is just weak governance in these companies, just the corporate governance, the board, the, holding accountable, how things are getting done. How much do you think of that is a weight for this institutional capital?
I think the pendulum has swung a little bit in that I think people are going to take that more seriously. There was a time for the hottest stories, everyone ignores the governance issues, right? And there's pluses and minuses. For like a committed founder to have Class A rights that really understands the business and goes like, you could argue that Mark Zuckerberg was that guy that like, nah, you know what, for shareholders, it's probably better to have him have super control. And then he puts a lot of money into VR, and we'll see, like, I don't want to debate that, but that could just be an example of like, oh, wait a second, that was the exact risk that happened, is that no one could call him on it because he had complete control. And so I think investors have become a little bit more mindful that, yeah, it's hot, but I think we've started to swing back a little bit more into like, okay, we need a little bit of checks and balances on this stuff. And a lot of these companies, the CEO and or chair people are really, there's not like a very challenge, like the board doesn't have a lot of stock ownership. They're not like, it certainly seems like there's not a huge check on their power. And then some of these companies still have super voting shares, right? Like, the couple of notable companies. And again, that could be really good, but I think if I had to guess, I would think that institutional investors would probably at least want to dial back some of that. Like, hey, start to convert some of these, class super voting shares into common. Let's all get in the same boat, and let's kind of roll that way.
Yeah. So what would what would be some of like your top metrics that you would, when you think for like institutional capital, growth, gross margin, governance, like what's kind of putting a bow on it here? What's your institutional grade metric?
If I'm institutional grade metric, I would actually try to figure out, and yeah, it's a little bit more onerous or whatever, but I would try to figure out, okay, how much money did these guys put into the business? How much money is it generating right now? Understanding that mistakes get made early and all this stuff. Like, how much money did they put in? Like, how much money did they put in last year, and what are they generating out of it the year before? Like, what's the return on capital, and how are they stewarding that going forward? Like, am I seeing the trajectory to, okay, this business is like, I'm not going to be putting a lot of money back into the business. They made the investments, and now we're going to reap the fruits out of those investments going forward. So I would be looking at actually kind of gross profit dollars and off of like, okay, how much assets are in the business, right? Because it's easy to generate more money if you're just investing more money back in, like, and balancing all of kind of balancing revenue, gross margin dollars, and how much capital is employed in the business. I know that I'm not talking about EBITDA, but those metrics to me, given where we are in the industry, are probably the most interesting. And I think institutional class people will get close to those metrics.
Yeah, I would agree with you there. When I talk to institutional allocators about Leaf and more broadly about the space, the thing I hear the most concerned about is on the top line. They're like, this space has the regulatory unlock. It has which is good potential. It has a ton of risk that we all know about. But to me, what's cooled a lot of the conversations more broadly in the industry have been the lack of top line growth after Florida didn't happen. PA gets kicked back another year every year. We basically haven't had any, Minnesota is important to a couple of companies, but since the, Maryland, Ohio, we haven't really had much to expand the TAM. And so I agree that with Jerry, your point is a little bit more sophisticated, which institutions should appreciate. But when I talk to them, they're just kind of looking at the space, and they looked at, revenues year over year being, flat to down. That's going to turn most folks off.
Yeah, I mean, listen, they're smarter than me, so they go, listen. That's like a shorthand for, if revenue's down, like that, you're not going to be able to make, there's not a lot of, you've limited how many situations you're going to have more profits in, right? Like growth is not one of them. It's going to be like cutting expenses more than revenue goes down. So it's like they're getting to kind of the same place. I think I think that where cannabis is weird is we kind of know where it's going to end up. Right. I think we have a good idea for not the hemp beverage, the stuff where people aren't, like the new consumers coming in. That's a kind of a big question mark. For the current consumers, I think it's a pretty easy equation as a baseline. You take, okay, how much do mature markets spend per capita on their regulated cannabis, and multiply that over however many states. And that eventually is kind of where you end up, I think, in terms of, so you kind of know what the TAM is going to be, right? Eventually. And the growth in cannabis it's absorption. You're taking things from the illicit market and putting in the regulated market. It's not like suddenly people are using that much more cannabis. They're not actually, like in some sectors they are, but generally speaking, like Sam is wrong. It's not, troves of people starting to become cannabis on. No, these are just people that are transferring their existing demand, right? So yeah, I think revenue is down I mean, that's a pretty good shorthand indicator for a lot of this stuff.
Yeah. Well, this has been a great chat, boys. Why don't we work on bringing this thing home? And in order to do that, as a good steward, I will say, sorry.
Why don't we criticize? Like, let's say meme things. I mean, I feel like I've been too nice. Like, I don't know. Did I take like a Xanax and forgot about it or something? Like,
you could have
more Tabasco.
Yeah, it could be the time of year, Jerry. Maybe we have to have you on more towards the holidays for more of an airing of the grievances type conversation.
I got a problem with you people. You're gonna know about it.
This has been a Seinfeld episode.
Do you guys have to jump? Like, because I was gonna ask you guys about the maps thing, because the maps thing was a really interesting move for me. I did not look deeply at it at all, but it's kind of fascinating to me because it really it hones down to like, okay, do you trust management and do you want to ride with them? Because they have, management there has exercised a good amount of control. It's pretty clear, like I think they're using, what is it? They filed a Form 15, so they're not doing. It's effectively like a go dark protocol, where you're not complying with like public filing stuff. You don't have to do it because you have under X amount of shareholders of record. But what's interesting is that you're not supposed to use that as a preview of going private. You're not supposed to like set there's rules against that, but it could be one of two things. It could be one of the biggest shareholder drubbings that I've ever seen, right? By basically insiders going, okay, like nobody's watching us. All right, we're just taking this thing private. This thing is worth more than, there's a huge cash pile. We still generate some cash. Like we're fine. We're gonna, or it's one of the most long-term value creating things in cannabis history that's actually kind of brave, where you go, listen, this Nasdaq thing, I know everybody loves it, but it's not working for us because we can't touch the plant. We can't do, we lose flexibility. We're paying $2 million a year to stay on Nasdaq with all the securities filings. You know what? We're just going to put it in our pocket and we're going to come back out when it's the right time as we continue to actually do what's right for the business, not for the stock in the short term. So I don't know, like, you guys have any thoughts on this?
I'll let you lead, Morgan. I haven't taken a good look at it.
If I'm a betting man, I'd take the former, not the latter.
Care to elaborate?
I think you said it all right there. I think you said it. I think.
If you're a podcast listener, Morgan has a grin on his face and is not speaking.
Yeah, I mean, they had all the time in the world to do something great, and they were riddled with all kinds of problems with security laws and stuff like that. And
yeah, the monthly active users thing that I do remember that. I think the problem with some of these businesses, like Weed Maps, it's tech, Weed Maps is a take on a portion of cannabis commerce. If cannabis commerce is suffering this, there's lack of revenue growth, you're going to see that reflected in the tech, right? As a general rule. So it doesn't follow this hockey stick of other tech companies, right? Of like Facebook, how many grandmas in Asia are going to be on Facebook? Well, we don't know yet. Well, I don't know. I think the expectations.
You got to be constantly innovating. You got to constantly be working and building, and they just, it was a nice cash cow basically, and and I know they had some failed attempts at trying to do some things, but they could have been acquisitive. They could have done all kinds of stuff and built, very, very large company, but they didn't. So now, it seemed like the mode shifted and they've moved into, let's just let this thing kind of go to a point where we can walk away with it. And that's what seems to be happening. I don't know. We'll have to see in time, but I don't know how much time they have to be dark before they can just affect that, go private. But again, if I'm a betting man, I'd say that's where it's heading.
Do you even need to go private once you're dark? You don't really need to. I mean, the government, like the governance and all that stuff, like just issue yourselves dividends that they can't stop, and that's it.
Good point.
Yeah, I think the world has changed so much around Weed Maps. And so personally, like Weed Maps, honestly, guys, changed my life in the sense that starting a dispensary that was largely delivery based back around 2016 in California, that is where the action was. And even in our region, I remember I was willing to pay as much as we could to get the best spot, because they rank order you in your region. There were 19 in our region, and the only spot I could get was 14. But the further you were up, the more quickly people would discover you. And then we focused on getting good reviews, which starts to naturally bounce you up, because people always sort things by reviews. And without Weed Maps, I wouldn't have had a centralized place to have people saying great stuff about our business to drive more customers to us. People fell off, we moved up, and it was something that really changed my life in terms of the cannabis industry and a way to get in and to be found. But I think that's changed the industry. I think it's changed with technology in general. Whereas if you're starting a dispensary today, I don't know if you need to pay what's got to be a lot more money to be on Weed Maps and be one of those highest ranked people. There's a lot more discovery out there with Google and Maps and other tools out there. So I think part of the challenge back in the day, I felt like from an operator's perspective, Weed Maps was just mandatory, necessary. That's where everybody went to buy weed. And I just think that isn't the case anymore.
I think that was the trick of the business, is that it's exactly the same as other cannabis. You're over earning in the beginning as people try to get discovered. As you get discovered, right? Like did your regular customers go back to Weed and need you to be on Weed Maps? No, they knew where your store was. They went to your store. Like if they're happy with your store, they go back. And so then it's like, okay, well, I'll pay for the minimum on Weed Maps. I already have my customers, right? And so it's a tough business. Like it's really tough. And then they didn't add a lot of value, right? Like a lot of their tools and stuff were bad. What's their competitor? It's Weed Maps and
Leafly.
Leafly, yeah, and that's another one that I was amazed by what Leafly was not doing. Like their whole strain specific thing, as brands of strains became big, I was like, guys, you guys really got to pivot this stuff. I think because like brands care if you want Kush from them or from someone else. You're not, and it's just like a different paradigm, and they just didn't do it for years. But anyway, whatever. Everything else good, guys? Canyon Ranch is good. Salisbury.
Yeah, things are going well at the farm.
Looks great.
Yeah, we were talking off camera. Was out there Monday, Tuesday for some meetings. The plants arrived on Wednesday, so we're getting the spring run going. Almost 1 million seeds were cracked, and we don't put the seeds right in the ground. We keep them at the nursery. They have little seed starts that are a few inches high, and then we go and stick those in the ground. So they're out there doing the planting this week, and those autos will take about 90 days. For you guys don't know, there's auto flower plants and photoperiod plants. Photoperiods require a light shift around 12 or less in order to start flowering. Autos don't care. You can put them in 24-hour light, and all they want to do is flower. So that's the way we get two harvests out of that big sun-grown field, is by using autos in the spring. So getting those in the ground now, and right around July, we'll be taking them out. So yeah, stuff's going well.
Congrats on getting that race done. And obviously, people that follow me know that I have a pretty high opinion of Aaron Edelheit, who I think led it, or at least is involved, and one of the best guys in cannabis. Regardless of what some people say about him, and a very good guy to have having been a co-investor with him in Grown Rogue, just would not want anyone else by my side on an investment. So as a partner, I'm happy you guys were able to land that. Look forward to seeing what you guys do.
Yeah, Aaron's been the perfect fit. I've known Aaron for probably 5 years or so, given that we live not too far from each other in the Santa Barbara area. And his firm is set up so well, and that Aaron's a great big picture thinker. I think he nails the big picture and gets the themes right. And then Fateh is analyst, who isn't a very public guy, but is really sophisticated, gets into all the details. Yeah, it's the deepest due diligence process that we've been through, and it was totally appreciated and helpful. We just worked through so many things with those guys, and so they've been great. And Aaron's investment, they put in 4.5 million so far, of up to 8 million. That's going to give us the capital to finish the farm. We've got the 180-acre permit. We've got 65 done, and we're doing the extra 115 this year with Aaron's money. So we're going to unlock some of that acreage in the spring, some of the fall, and then have the full 180-acre permit size done for next year. So, yeah, it's been awesome, man. It's we were out there trying to find the right partner for capital, and so many bad actors out there, so many deals you wouldn't want to take, so many predatory things, so many jerks in this space. So for us to find capital, I was talking about the pref. We did some pref and did some common, so the structure worked, and then to do it with a good human being that really believes in what we're doing, it's just been a perfect fit for us.
Nice. Morgan, what about you? Anything? What's going on in your universe?
Oh, we're
What's
cranking.
What's with the world map behind you? Are you in your kid's classroom or something?
This is San Francisco Bay.
Oh, nice. Very nice.
It's a nautical chart.
Oh, you're a sailor. That's right.
Yeah.
I got my basic keelboat qualification at Manhattan Sailing Club.
All right.
So I'm something of a sailor myself on a J24. Yeah. Oh yeah. You almost capsized it in the Hudson, but yeah, that's me. Nice. No, good stuff, guys. Thanks for having me on. Always fun to BS on these topics with you guys. So thank you.
Yeah, appreciate you coming back. I think this is your second time on, Jerry. First time on video. Does that sound right?
Yeah, probably. Yeah, again, we talked about it before the show. I'm a lot uglier than you guys. So I don't know if I want to do video again. It's not. I gotta work on this a little bit, but yeah, it's second time. Second time is a charm. We'll let's make it a regular check-in, guys. Let's just do it. Every couple months. Let's shoot the shit.
Yeah, sounds good, man. This was a perfect show. Just the casual conversation we'd want to have anyway, but let's do it in public. So thanks very much for joining us. Thank you to FlowHub for making today's show possible. 420, guys, is just 11 days away. It's going to be busy, and you need the best dispensary software right now, right this moment. Go see what's possible at flowhub.com. And if you're out there on the conference circuits, they are going to be out there as well. They're going to be at, is it NECAN? Northeastern Can, Boston, April 24th, 25th. The Exchange in Michigan, May 6, 7. Revelry, Hudson, New York, May 13. And last, if you're in the Great Buckeye State, go to the Ohio Cannabis Expo, May 22nd and 23rd. Ooh, that's a cool background noise. But Jerry, good to see you, my friend. Morgan, always fun to talk with you. Thank you all for listening, and we'll see you guys in 2 weeks. The views expressed in this podcast are provided for informational purposes only. Nothing we said should be considered research nor recommendation. All investing involves risk, including the loss of principal.